Welcome to the deep dive.
Good to be here.
So today, we're tackling a specific trading idea, a short-term one.
Right, this comes from Mansi's Trading Tip 21.
Exactly. And our goal really is just to unpack it, see what the core parts are.
And figure out, how it might apply if you're looking for those quicker trade setups.
Okay, let's jump in. First thing, the time frame. It's a 15-minute chart.
Yeah, 15 minutes, that's pretty quick.
What does that immediately tell you, using such a short window?
Well, it tells you you're trying to catch very short bursts of momentum, tiny moves within the day.
So probably more signals.
Potentially, yes.
Yes.
More signals, but it also means, you need to be paying attention, pretty actively watching.
Right. Definitely not a set it and walk away kind of thing.
No, not at all.
Okay, let's get into the actual buy signal. How does it work? Condition 1.
First thing, the price. It needs to be trading below the 5-period exponential moving average, the 5 EMA.
The 5 EMA, right?
Yeah.
Which is notoriously fast-moving, isn't it?
Extremely responsive. It really weights the latest price action heavily.
So being below it suggests a very recent dip.
In that very short time frame, yes.
Yeah.
A little downward push.
Okay. Now here's a detail I found interesting. The high of that potential signal candle, it shouldn't touch the 5 EMA.
Right. No contact.
Why? What's the thinking there, do you think? This no-touch rule.
Well, it's suggesting perhaps that the downward pressure is still there.
Yeah.
It hasn't bounced enough to even reach that very short-term average.
Ah, so it's like the bounce isn't strong enough yet?
Kind of.
Lit.
It implies there might still be some weakness, but if it then breaks upwards.
Okay. So that leads to the trigger. Price is below the 5 EMA, the high didn't touch it. What actually gets you in the trade?
The trigger is the next candle, the one right after your signal candle.
What about it?
It has to cross above the high of that signal candle.
Ah, so it needs to break that previous little peak.
Exactly. That break is your confirmation. It suggests maybe that brief downward momentum is shifting. We might get a pop higher.
So you wait for candle number 2 to actually push through. Got it.
Precisely.
Now, protection. Every strategy needs it. Stop loss.
Absolutely crucial. Risk management first.
Where does it go here?
The strategy says place it just below the low point of the signal candle.
The signal candle's low. Okay.
Yes, the same candle we checked for the no-touch rule.
Yeah.
That's your line in the sand.
Your safety net, basically. If it breaks that low, the idea is probably wrong.
That's the logic. Limit your potential loss if it keeps going down.
Makes sense. Clear exit point if it fails. What about when it works? The target.
Profit target. This strategy uses a fixed risk-reward ratio.
Okay, which is?
It aims for 1 to 2, a 1.2 risk-reward.
Meaning?
Basically, however much you risked the distance from your entry to your stop loss, let's say that's $1 per share.
Yeah.
You're aiming to make $2 per share in profit.
So double the risk amount is the target game.
That's it. The idea is that winning trades should, ideally, make twice what losing trades cost you. Gives you a potential edge over time.
Okay, interesting. So let's quickly recap this Mansi's Tip 21 strategy for buying. 15-minute chart.
Right. Price below the 5 EMA.
Signal candle high does not touch the 5 EMA.
Correct. And wait for the next candle.
To break above the signal candle's high, that's your entry.
Stop loss goes below the signal candle's low.
And you're shooting for a profit that's twice your risk, that 1.2 ratio.
That sums up the mechanics of this specific idea.
So here's a final thought for you listening in. Think about this. How does using a defined risk-reward ratio, like this 1.2 target, fit into how you look at trades?
Yeah, it's not just about finding an entry signal, is it?
Right. It's about the whole calculation. What you stand to gain versus what you stand to lose. How does that equation shape your decisions?
Definitely something worth considering. Any kind of market analysis or trading plan, that risk-reward balance is, well, fundamental.